Thanks for joining us for the Executive Series. Today I'm talking to Kerin, who is the CEO and Managing Director of CSG Ltd. Julianne, it's great to talk to you again.
Hey Tom, how you doing?
I'm well. And you've just recently announced results. Quite a good performance for the last period. NPAT up by about 27%. What were some of the other factors that stood out for you?
I think the big standout for the year for us was the management of the transition of the business from, its traditional base in print into what we've talked about for some time now, but into growing our strategic pillars for growth around our technology business and our as-a-service model for small and medium enterprises. And, we saw fantastic growth in that part of the business, and also, again, 30% growth in our enterprise business, so which we started really from nothing in 2015. So, we were really pleased with the results. Obviously, there were some misses in the enterprise business with about $10 million worth of revenue that we would have liked to have seen. But aside from that, we think that the business managed, a really big year of doing a lot of things behind the scenes that don't necessarily, people don't necessarily see. But we think that we've positioned the business with a great platform to grow both in the enterprise sector and in the SME sector into FY17 and beyond.
So the second half of the year saw you release the full suite of technology and service products. What sort of an impact did that make?
It had a really big impact on the business, and we modelled that in our result presentation, but we signed 307 new customers in the year. We started selling out total office bundle into small and medium enterprise business, and we really saw some really great growth around the technology business, not only in equipment sales that we package and fund through the lease book as our as-a-service model, but more importantly, the growing subscription base of software subscriptions. And the really exciting thing that we're seeing is proving out our model, which is getting commitment for people around those annuity subscriptions for 60 months, because our plan was always to take the way we sold in the traditional print business and translate that into delivering that to customers around technology. And the really big tick for us was that we saw that starting to work.
Indeed, and you had some early wins with the display solutions side of things as well?
Yeah, we did. So we had some really good, what I call multi-location wins. So around the retail space, in real estate, we're partnering with a really interesting company around digital signage for replacing traditional real estate signage. And then we partnered with a company called OneView in the healthcare space, and we'll continue to work with them rolling out displays into hospitals where they provide the software and we provide the display and service of those devices.
So when you look ahead to the next 12 months, what are your expectations?
Yeah, so to really continue to take the technology bundles to our existing customer base through our existing channel. That's the first thing. Second thing is we announced that we will launch a new direct sales force that will target new customers. We really believe when we look globally that we have a first mover advantage around our as-a-service bundles, and we know that we're still the only people that deliver that the way we deliver that on a single bill and on a monthly operating expense model. And so we will continue to target new customers and maximise the advantage we have with a first mover advantage in that space. And then in the enterprise space, now that we're no longer restrained, that came off last year as well, around technology sales into enterprise, we'll focus going back into a sector where we think there's a lot of tier ones now in Australia, in multinational tier ones. Some of the listed Australian companies have been acquired during the year, like our old business was, and we think there's a big gap left for us to play in that mid-market around managed IT services.
Okay, and you're also in a good position to be able to gauge what the business climate is like in Australia. How would you characterise it at the moment?
Yeah, it's patchy is the word I'd use. I think different sectors are, we see, obviously we have a big education base, and so we continue to see investment in education. We're absolutely seeing the shift from capital expenditure to operating expenditure, and so we think that our as a service model is really well suited to that. There's no doubt that when we start to talk to people about saving them time and money, that people are looking to reduce cost in small and medium enterprise. And, they're also looking to be able to predict, they're scared of adding people and adding cost. And so, we think that our ability to help them predict, how much it's going to cost to add a new head, it's really easy to say, if I add a new person, it's going to cost, 200 or whatever it is per month more to my existing IT platform. And that makes it really easy for them to also to scale up and down. So we give them the ability to scale up and scale down. And so, I think that's an important factor as well. But I think it is really patchy out there. I think healthcare, education, sectors that we're really focused on are good and solid. Our mining services companies obviously not growing, and so we're focusing our attention on areas where we see solid business. Our bad debt rate in the finance book is a good reflection though of the way we choose the sectors that we deal with, and we provided some light on that in our investor presentation. But less than 0.5% still in bad debt rate in the finance book. So that's across Australia and New Zealand. So that's a good indicator that we're doing things right in picking where we sell.
Julie, great talking to you.
Thanks
for your time. And thanks for joining us for the Executive Series.